Is the Federal Reserve actually bankrupt? Are they insolvent? And if so, what does that actually mean for you? Because you, like pretty much everyone else that experienced 2020 and 2021 realizes, is that the Federal Reserve has the ability to print money. So how do you have an entity that has the monopoly on creating dollars out of thin air, just digitally printing them into existence? How does an entity like that go broke? How do they get to the point where they are operating at a loss? And is there any significant consequence of that for the broader economy? Lynn Alden recently wrote a great article about this called How the Fed Went Broke. You can find it on her website, lynnalden.com. And she put together some great charts that I'd like to show you to illustrate what's going on here. Long story short, yes, the Federal Reserve is operating at a loss, but that doesn't mean that they cannot continue operating indefinitely that way, because they can print money, but there are also some negative consequences for other entities, especially like the US government as a result. First, we need to take a look at their balance sheet. They have a balance sheet that is currently worth about $8.3 trillion. Consider this balance sheet just like you would your brokerage account. In your brokerage account, let's say you've got $200,000 and that's invested in things like Apple stock and maybe some bond funds. That's exactly what the Federal Reserve's balance sheet is. They've got $8.3 trillion worth of assets like mortgage-backed securities, which is like a mutual fund made up of mortgages, and number two, treasuries, which is just bonds, just debt to the United States government. And so as mortgage payments are being made, as mortgages are being repaid in full, and as the US government pays off debt when it matures, and they do that by borrowing more debt, but when they pay that off, that money goes to the Federal Reserve, in addition to the interest payments on all that debt along the way. So $8.3 trillion of interest-bearing assets that are all paying them every month, every quarter, every year. That sounds like a pretty good deal, except for the fact that all these assets were purchased at record low interest rates. When the Federal Reserve lowered interest rates and also started buying up a bunch of these assets, interest rates were super low, and so all these assets are barely paying them anything. Now, there's 8.3 trillion of those assets though, so the amount in total was still a lot, but now we have to get into their expenses, because the Federal Reserve does have expenses. One of those expenses is just their salaries. They are the biggest employer of PhDs, which is crazy because none of them know actually what the real world is like or what is actually going on. But they do employ a lot of people. They've got great salaries. They got great bonuses. It's a great gig if you want to get into a job that is secure and not going to be reliant on the business cycle. But that is not their biggest expense. Banks keep their reserves at the Federal Reserve, and right now there's about $3 trillion that banks have in reserves. Remember, the central bank, like the Fed, is just a bank to other banks. So banks need to keep their assets somewhere, just like you and I keep our assets at the bank. We deposit our assets, our reserves with the bank. The bank does the same thing to the central bank. They deposit their assets, their reserves, their savings in their account at the Fed. And just like you get paid interest on your checking account balance, right now it's probably 1.25%. Well, the banks also get paid interest from the Fed for their reserves. There's about $3.1 trillion at the Fed right now that belongs to banks. And there's another account at the Federal Reserve called the reverse repo facility that has about $2 trillion in it. For all intents and purposes, for the topic of this conversation here, these are the same thing. So banks have a ton of cash, a ton of reserves, so they place it either with the Federal Reserve in the reverse repo facility or at the Federal Reserve as reserves. So banks have about $5 trillion on deposit with the Federal Reserve right now. And what has the Fed been doing with interest rates recently? The Federal Reserve has been increasing interest rates on the Fed funds rate. This is the amount that they pay to banks for their reserves, to the tune of 4.5% right now. But that's just $3 trillion. What about the other $2 trillion in the reverse repo facility? Yep, you guessed it. The Federal Reserve has also been raising the interest rate that they pay to banks on the reverse repo facility funds. Again, about 4.5%. So there's $5 trillion that banks have right now in reserves, and they could do anything they want with this. But they have it at the Fed right now in savings because they're getting paid risk-free 4.5%. Now, the Federal Reserve is losing a crazy amount of money by doing this. They're making a lot of money from the balance sheet that they have, but they're spending a lot more money just to pay banks for banks to keep all that cash with them. This has created charts like this that you've probably seen all over the internet, where this amount is called Fed remittances to the Treasury, and it just fell off a cliff. So what in the world is that? Well, normally the Federal Reserve operates at a profit, meaning they've got their balance sheet and then they've got their expenses, and usually they make more money in income than they have to pay out. So they've got a big amount of money left over. And by law, what the Fed does with all that money left over, they just hand it to the US government. That's right. So the Federal Reserve, despite what you've heard, is not a fully private institution. It's quasi-private because of the way that the regional banks are set up, but it's quasi-public, and when they do have profits, which they normally do, those all get swept back to the US Treasury. In 2021, the Federal Reserve earned over $100 billion in income from its balance sheet, and the majority of that was sent over to the US Treasury, which means that for the amount of US debt, Treasury debt that the Fed owns, all those interest payments, it's coming right back. So any US debt, national debt that the Fed owns, has been interest-free debt pretty much for the government. It also means that all the money that you're spending on your mortgage, the interest payments on top of your principal, that was going to help out the US government pay their bills as well. But all that changed recently, and the amount of money the Fed sends to the US Treasury went negative. And no, just to put an end to this rumor once and for all, this does not mean that the Treasury is paying the Fed. The Fed still just prints all the money they need for all of their expenses. This amount represents what dollars they'll have to pay themselves back when they do become profitable. You heard that right. So let me explain this. Let's say normally they send $100 billion to the government. This year, they actually operate at $100 billion loss, let's say. Well, that means that next year, if they become profitable again, they keep $100 billion before they send back more money over to the government again. So they're printing $100 billion extra to pay the banks right now. When the banks finally start paying them back, they destroy that money by keeping it before they send that money over to the Treasury. Again, assuming if and when they ever do become profitable again. But this number here is a little bit misleading because all through here, this is the weekly number, and right when it goes negative, it becomes cumulative. So this is a better chart that Lynn created that shows the weekly amounts still when it becomes negative, and you can see there apples to apples. The orange line shows the total cumulative all along the way. This is all the money they've ever sent to the Treasury, and now that they're not sending money to the Treasury, that dollar line is going down. Okay, so to recap. Normally, the Fed uses its income from its assets to pay all of its expenses, and it has some left over. So it gives that back to the government, and then the government uses that to help it pay its bills so it doesn't have to run as large of a deficit. Now, that's not happening anymore. Now, the Federal Reserve is printing money to pay the banks so the banks keep more money with them. In addition to that, the Federal Reserve is not sending more money to the Treasury anymore, so the Treasury has to borrow more in order to pay its bills. So let's discuss in detail those two things. Why is the Fed paying so much to banks right now? The express purpose of this is to tighten. They're trying to keep that $5 trillion out of the economy. They don't want banks to lend to the United States government because they want rates to go up. If that $5 trillion goes out and buys, it wouldn't be the full $5 trillion, but even $1 trillion of that goes out to buy US Treasuries, rates go down, that's a stimulus effect on the economy, more money available for cheaper, and inflation keeps on going up. But the Fed is trying to tighten right now. They don't want that money made available for private loans. They don't want that money made available to go out and spend. They're trying to incentivize savings all across the board. So your checking account goes from 2% to 3%. Maybe you get 4% by loaning to the government, 5% to buy a 1-year Treasury. This is incentivizing people to stop spending money, start saving money, to slow down the rate at which people are spending, to slow down the rate of inflation and potentially even push us over into deflation. If everybody stops spending money, prices collapse. That's exactly what they're trying to do. Get people, companies, and banks to stop spending money. And banks especially, they don't want to lend, so they're saying, we'll pay you and make you an extremely good deal just to incentivize you to not loan out cheap money to everybody else. In other words, make borrowing very expensive and saving very attractive, and you can crush inflation, but you'll probably spark deflation. The second consequence of this is that government borrowing has to go up because they just lost out on a large chunk of income. Losing $100 billion in annual income is the same size as 4 times NASA's annual budget. And given the fact that they will never spend less, this means that they're going to have to borrow another $100 billion per year. Meanwhile, institutions like banks are being paid to not lend to the United States government. And so that means interest rates go up. So when interest rates go up and borrowing goes up, you know that the interest expenses longer term for the government are about to get very ugly because they'll have to continue borrowing more just to pay off their old debt. And every time they do that, they're taking on a higher interest rate. It's a snake eating itself by the tail. Long term, this probably means the Federal Reserve starts buying US treasuries again and may just consume the entire national debt so that there's effectively no more interest expenses for the government. But that likely will not happen anytime soon. What it does mean will happen anytime soon is probably more economic pain. We probably have not seen the deepest part of the recession yet, which means asset prices may continue to go on sale. If you would like to know how I identify the best companies and figure out the best prices so that I'm, actually objectively buying them on sale and not just saying, oh, well, it fell 15%, so that's cheaper than it was before, might as well buy. No, if you want to know you're actually buying companies when they're a good deal, get my bear market investing guide linked in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.